On October 3, 1913, President Woodrow Wilson sat at a polished mahogany desk in the Oval Office and signed House Resolution 3321 into law. The air in Washington was heavy with autumnal rain. Outside, the news spread fast through telegraph wires to financial trading floors in New York, Chicago, and London. A crowd of congressional leaders stood behind the president, smiling for photograph cameras. Wilson used a black wooden pen with a steel nib, dipping it into a silver inkwell to sign his name. It took less than 30 seconds. The stroke of his pen abolished decades of high protective tariffs and replaced them with Section II of the Underwood-Simmons Act. It was a 3-page statute buried inside a 100-page bill. It reestablished the federal income tax in the United States. Supporters called it a triumph of populist justice. They promised it would only affect the top 1% of earners. They insisted the bottom 99% of Americans would never pay a single dime. The tax rate was set at a modest 1% for individuals earning over $3,000 a year, equivalent to nearly $90,000 today. For those earning millions, a maximum surcharge capped the total tax rate at 7%. It was presented as a temporary, minimal measure designed to lower prices at the grocery store by removing import duties. Yet inside the Treasury building just steps from the White House, clerks were already preparing Form 1040, a thin paper document that would alter the financial fate of every citizen. Tucked inside the text of that statute was a definition of income so expansive that it gave the federal government an implicit, unyielding lien on the private product of human labor. How did a temporary 1% levy on America's wealthiest elite transform, in less than 30 years, into an inescapable mechanism extracting up to 37% of every working citizen's paycheck? To answer that, one must look past the speeches in Congress and follow the trail of debt, central banking, and war finance that rewrote the balance of power between the citizen and the state. In 1913, the federal government of the United States was tiny compared to modern standards. Total federal spending stood at roughly $715 million, less than 2% of gross domestic product. The national debt sat at a manageable $1.2 billion, a remnant of Civil War bonds that were steadily being retired. Government revenues were derived almost entirely from two sources: excise taxes on alcohol and tobacco, and tariffs collected at maritime ports of entry. At the Custom House on Bowling Green in Manhattan, inspectors examined steamships laden with European steel, textiles, sugar, and machinery. In 1912 alone, customs duties generated over $318 million, representing nearly half of all federal revenue. But this system had created a structural crisis. High protective tariffs shielded powerful industrial trusts, such as United States Steel and the American Sugar Refining Company, from foreign competition. These monopolies kept domestic prices artificially inflated, squeezing rural farmers and urban wage earners while funneling enormous wealth to Wall Street financiers. The public was furious. Bread riots, labor strikes, and agrarian revolts swept across the Midwest and the South. The political establishment faced a choice: reduce the tariffs and lose the revenue needed to run the government, or find a new source of funds that could replace customs duties without bankrupting the Treasury. Enter Cordell Hull, a 36-year-old congressman from the rural 4th District of Tennessee. Hull was born in a log cabin in the upper Cumberland River Valley. He grew up watching small farmers lose their lands to mortgage foreclosures while paying exorbitant prices for manufactured tools protected by Eastern tariffs. Hull was not a fiery orator, but he was a relentless legislative craftsman. After earning a law degree at Cumberland University, he spent years studying the tax structures of Great Britain and continental Europe. Hull became convinced that protective tariffs were a legalized fraud perpetrated by Eastern capitalists against working-class Americans. When he arrived in Washington in 1907, he brought a single-minded obsession: drafting an income tax law that would break the power of the trusts once and for all. For 6 years, Hull collected economic statistics, studied Supreme Court precedents, and drafted legal clauses in his cramped office in the Cannon House office building. He argued that an income tax was the only equitable mechanism to force the ultra-wealthy, men like John D. Rockefeller, Andrew Carnegie, and J.P. Morgan, to contribute to the maintenance of the nation that created their fortunes. In the spring of 1913, Hull's moment arrived. The ratification of the 16th Amendment in February had cleared the constitutional hurdles that had invalidated an earlier income tax attempt in 1895. President Wilson appointed Hull to draft the income tax section of the new tariff reform bill. Hull worked 18 hours a day, filling legal pads with precise calculations. He wrote clauses designed to exempt working families while targeting the immense dividends, interest payments, and capital gains flowing into the bank accounts of Manhattan's Fifth Avenue mansions. Inside the committee rooms of Capitol Hill, however, a very different negotiation was taking place. Opponents of the tax, led by conservative Republican Senator Nelson Aldrich of Rhode Island, fought fiercely against the proposal. Aldrich, whose daughter had married John D. Rockefeller Jr., was the undisputed champion of Wall Street interests in the Senate. During the floor debates, opponents warned that introducing a direct income tax was a dangerous precedent. Senator Elihu Root of New York argued that once the legal machinery of income taxation was established, future governments would inevitably lower the exemptions and raise the rates until every wage earner became a financial vassal of Washington. Hull and his allies countered these warnings with absolute reassurances. They insisted that the exemption threshold of $3,000 for single individuals and $4,000 for married couples was sacrosanct. Less than 3% of the American population earned enough money to qualify. To further appease critics, Hull agreed to a progressive structure: a base rate of 1% on net incomes above the exemption, with a gradual surtax reaching 6% only on incomes exceeding $500,000, an astronomical sum at the time. While Congress debated the income tax in the summer of 1913, a parallel financial drama was unfolding in secret. 3 years earlier, in November 1910, Senator Aldrich had boarded a private railway car in Hoboken, New Jersey, under the cover of darkness. Accompanying him were 6 men representing the nation's top financial houses, including Paul Warburg of Kuhn, Loeb & Co., Henry Davison of J.P. Morgan & Co., and Frank Vanderlip of National City Bank. Their destination was Jekyll Island, a private hunting club off the coast of Georgia. For 10 days, these men worked under assumed names to draft a plan for a central bank. Wall Street had been rattled by the panic of 1907, when the failure of the Knickerbocker Trust Company triggered a systemic liquidity freeze that required J.P. Morgan himself to personally rescue the financial system. The bankers recognized that private bailouts were unsustainable. They needed a central bank capable of issuing an elastic currency and acting as a lender of last resort. But they faced a formidable obstacle. The American public deeply distrusted a centralized money trust. When Woodrow Wilson won the presidency in 1912, the financial establishment adapted its strategy. Rather than fighting Wilson's Democratic majority, they worked behind the scenes to shape the proposed Federal Reserve System. But a central bank cannot function in a vacuum. To issue paper currency and purchase government securities, a central bank requires a sovereign government with a stable, guaranteed stream of revenue to service its debt obligations. This was the hidden nexus of 1913. The Federal Reserve Act and the Underwood-Simmons Tariff Act were not separate reforms. They were 2 halves of a single financial architecture. The Federal Reserve System, signed into law by Wilson on December 23, 1913, just 11 weeks after the income tax, created the mechanism to expand federal debt. The 16th Amendment provided the collateral, the future earnings of the American workforce. The contradiction at the heart of the 1913 tax reform was immediate. It was sold to the public as an anti-Wall Street measure that would reduce the cost of living. Yet by replacing physical tariffs on foreign goods with a direct tax on domestic income, the federal government uncoupled its revenue engine from international trade and attached it directly to private economic activity. Under the tariff system, if the government spent too much, it had to raise import duties, which risked depressing trade and triggering public outrage at the store counter. Under the income tax system, government revenue could scale alongside economic productivity. For the first few years, the system functioned precisely as promised. In 1914, the Bureau of Internal Revenue collected less than $36 million from individual income taxes. Fewer than 360,000 tax returns were filed out of a national population of nearly 100 million people. Form 1040 was simple, requiring basic arithmetic on 3 pages. Wealthy citizens paid their modest levies, tariffs were reduced, and the average worker noticed no change in their daily life. Then, in August 1914, artillery shells began detonating across the battlefields of Europe. World War I broke out with catastrophic force, shattering international trade routes overnight. As European nations shifted their industrial capacity toward total war, merchant ships stopped carrying consumer goods across the Atlantic. U.S. tariff revenues plummeted by tens of millions of dollars in a matter of months. At the same time, European governments began borrowing billions of dollars from American banks to purchase munitions, grain, and oil from American factories. Washington faced an unprecedented fiscal shock. Collapsing customs receipts combined with urgent demands to arm and supply its allies. The temporary income tax was no longer a populist experiment. It became the sole financial lifeline of the state. In 1916, as military tension escalated, Congress passed the Revenue Act of 1916. It doubled the normal income tax rate from 1% to 2% and raised the top surtax to 13%. It also introduced a corporate income tax and an estate tax. But this was merely a prelude. When the United States formally declared war on Germany in April 1917, federal expenditures exploded from $734 million in 1916 to over $12 billion in 1918. To fund this staggering expansion, Congress passed the War Revenue Act of 1917. The transformation was swift and ruthless. The exemption threshold was slashed from $3,000 to $1,000 for single persons, dragging millions of middle-class clerks, factory workers, and mechanics into the tax net for the very first time. The lowest tax rate jumped from 2% to 4%, while the top rate skyrocketed from 15% to 67%. By 1918, the top rate reached 77%. The number of filed tax returns surged from 400,000 in 1915 to over 5 million in 1920. Individual income tax collections leaped from $41 million to over $1.4 billion in just 3 years, a more than 30-fold increase. The infrastructure built to tax the ultra-rich had been expanded to extract wealth from every level of society. The federal government was no longer funded by voluntary consumer choices at the customs terminal. It was funded by mandatory claims on human labor. When the war ended in 1918, taxpayers expected the war rates to be repealed and the original 1913 exemptions restored. During the 1920s, Treasury Secretary Andrew Mellon did engineer significant tax cuts, lowering the top rate to 24%. But the underlying structural apparatus remained intact. The Bureau of Internal Revenue had grown into a massive legal and bureaucratic agency with auditors, enforcement agents, and legal departments operating in every state. When the Great Depression hit in 1929, government revenues collapsed once again. President Herbert Hoover, panicked by mounting budget deficits, signed the Revenue Act of 1932, raising the top income tax rate back up to 63%. Under Franklin D. Roosevelt's New Deal, tax rates climbed higher still, reaching 79% by 1936. The state had discovered an unyielding fiscal law. Emergency spending creates permanent bureaucratic commitments, and those commitments require an ever-expanding tax base. The final, irreversible step in this transformation occurred during World War II. In 1942, as the nation mobilized for conflict on two oceans, federal spending reached heights unimaginable in 1913. President Roosevelt called for a tax structure that would capture every available dollar in the economy. The Revenue Act of 1942 reduced exemption thresholds to $500 and raised the top rate to an astonishing 94%. Overnight, the number of tax-paying Americans ballooned from 13 million to 44 million. The income tax was no longer a class tax. It had become a mass tax. Yet the Treasury faced a severe practical problem. Collecting taxes at the end of the year in one lump sum was failing. Millions of working-class families, living paycheck to paycheck, did not have saved cash to pay massive annual tax bills. Default rates soared, and the Treasury was starved for immediate liquidity to pay defense contractors. The solution came from Beardsley Ruml, the chairman of the Federal Reserve Bank of New York and treasurer of R. H. Macy and Co. Ruml, proposed a brilliant administrative mechanism. The current Tax Payment Act of 1943, better known as payroll withholding. Under Ruml's plan, employers were required by law to deduct income taxes directly from workers' paychecks before the workers ever saw the money. Withholding changed the psychology of taxation forever. By intercepting wealth at its source, the government eliminated the friction of manual payment. Citizens no longer felt the pain of writing a check to the Treasury for their full tax burden. Instead, they adapted to living on their net income, viewing annual tax refunds not as a return of their own interest-free overpayments to the government, but as a generous gift from the state. I want to be careful here. It is tempting to look back at the events of 1913 and see a seamless, villainous conspiracy hatched by mustache-twirling financiers in smoke-filled rooms. But history is rarely that simple. Cordell Hull was not a shill for Wall Street. He was a genuine idealist who truly believed he was dismantling corrupt corporate monopolies. Woodrow Wilson believed he was establishing a modern, scientific system of public finance to fund infrastructure, education, and public health. The tragic irony of the 1913 tax reform is not that it was conceived in malice, but that its creators failed to comprehend the structural dynamics of state power. When you build a machine capable of extracting wealth directly from the populace, that machine will eventually be acquired by interests far removed from its original purpose. The combination of an income tax and a central bank created a financial feedback loop. The Federal Reserve enabled unlimited government borrowing, while the income tax guaranteed that citizens would pay the interest on that debt through perpetual taxation and currency inflation. Today, federal income taxes generate over $2.2 trillion annually, accounting for roughly half of all federal receipts. The national debt stands above $34 trillion. The average American works until mid-April every year just to pay their federal, state, and local tax obligations, a period known as Tax Freedom Day. The temporary tax that was promised to cost no more than 1% on 3% of the population now reaches into almost every household in the country. The story of 1913 is not merely a chapter in a history textbook. It is a permanent lesson in how fiscal power expands. Whenever a government promises a new, minor tax that will only apply to the wealthy, or a temporary surcharge to handle a temporary emergency, history offers a clear, unyielding verdict. Emergency measures become permanent institutions. Exemption thresholds are eroded by inflation, and taxes designed for the top 1% inevitably become the burden of the middle class. The pen that Woodrow Wilson used in 1913 did not just lower tariffs, it signed away the financial autonomy of future generations. If this analysis helped you understand the financial machinery that shapes our world today, leave a comment with the word ledger down below. Subscribe to Chrono Dominion, and join us next time as we follow the money through another forgotten corridor of history.